All right, everyone. Today I'm trying to go through as many multiple choice questions as I possibly can on portfolio management, risk management, corporate finance, all that fun stuff. So let's get through it. First off, which of the following is the best example of a systematic risk factor? A factory fire that halts a company's production, an unexpected increase in the national inflation rate, the sudden resignation of a company's CEO, or a competitor launching a successful new product. Okay. So we just need to cover what systematic risk is versus unsystematic risk. So just a reminder here that a systematic risk is a risk that impacts everybody and can't be diversified away, while an unsystematic risk is a company or industry-specific risk. And so a factory fire is a good example of an unsystematic risk. It's a risk that happens because you had that specific location subject to the fire. An unexpected increase in the national inflation rate is an example of systematic risk, right? That's going to happen to all the companies. It can't be diversified away. So we're going to talk about diversification theory here a bit, and it's important to note that when we're talking about diversification theory, the whole point of diversification theory is to diversify away unsystematic risk. You're left with systematic risk, which still needs to be managed, and everyone just has to accept. And the whole goal is if you're taking on systematic risk or any type of risk, you want an incremental layer of return that's incremental to the risk that you've taken on. So just a reminder for everybody, there is the correlation coefficient P. -1 means that correlation is complete opposites. And if you have a correlation of +1, those are perfect correlations. So in a marketplace, if the S&P 500 is perfectly correlated with the S&P 500, and any asset that matches the S&P 500 very closely will be close to +1. If there's an inverse relationship, it would be -1, and 0 means no linear relationship. There's no relationship or recognition at all. And why does this matter? It matters because as we diversify our portfolio, we want to diversify unrelated assets that aren't correlated with each other. If I am going to buy a company like Ford and then also a company like GM, I'm still very at risk. Those should be pretty correlated with each other, and I'm still pretty prone to the automotive industry overall, especially the American automotive industry. And so obviously I'm not getting the maximum diversification benefits. If I had a company like Ford and then a company like, let's say, Tesla is a better diversification. Microsoft would be even better diversification. If we start going to pharmaceuticals, that'd be even better, right? Going to completely unrelated assets, you would get a better diversification benefit. So the perfect diversification benefit would be a completely negative correlation coefficient, but that doesn't really happen in practice. But if we were to do that, we could essentially create a 0 to very low standard deviation in our portfolio. So that would be the answer of C. It wouldn't guarantee a return equal to the risk-free rate. That's nonsense. Maximize the portfolio's exposure to unsystematic risk. That's not true, and that would never be the goal. And ensure the portfolio's beta is exactly 1. There's no relation. Hopefully you get the answer there is C. 43, as you add more randomly selected stocks to the portfolio, we just talked about that, is as you add stocks, as long as they're not perfectly correlated with each other, you're going to decrease your unsystematic risk. So the answer there would be D, which is correct. Remember, the whole goal of diversification is to lower unsystematic risk. As you diversify, you actually mitigate the risk without offsetting all of the return. So you get an incremental benefit to the risk diversification, or we lessen risk at a greater rate than we lessen the return. And you take the average of the overall returns, but you take an exponential version of that from a risk perspective on the risk decrease. So there's really an advantage to diversification. Okay, the standard deviation of a 2-asset portfolio depends primarily on the weighted average of the 2 asset standard deviations plus the covariance and correlation between them. If you have 2 uncorrelated assets or assets that are different, have different relationships to the market, you actually get a benefit greater than the averaging out of the returns. And that's why we diversify. If that wasn't true, we wouldn't diversify, because then you'd always want the maximum risky asset to get the maximum return. So 45. Portfolio has 70% invested in stock A that has an expected return of 12% and 30% in stock B that has an expected return of 8%. What's the portfolio's expected return? Here, you're just doing weighted averages. All right, and so everyone in this class should be able to do weighted averages by now. Just a reminder, how we'll do part of it. You take the 0.7 multiplied by the 12%. You add that in with the weighting of stock B, the 30% of the 8%, which gives you 24%. and that'll give you a 10.8% answer. So the answer here would be your C. And the big takeaway here is that when you diversify your portfolio, you just take the average of the returns that you expect within that portfolio, which makes sense. If you have 70% in stock A and it returns 12%, and 30% in stock B that returns 8%, you're going to get the average of those returns, which is 10.8%. What we'll find is in the similar stock, though, you'll get the standard deviation will actually have an exponential offset. So if a correlation is 0, you'll see that offset is not as significant as if it was -1. And if it was 1, you wouldn't get anything. We have the correlation, which is 0, and we have equal weightings for each. We can see the formula here, but essentially what we're doing is we're just plugging it in. We're going to take the portfolio weights here. We're going to plug them in. 0.5 multiplied by 0.25 squared plus 0.5 multiplied by 0.15 squared plus 2. The stocks in the portfolio, this is just for a 2-stock portfolio, multiplied by 0.5, the weightings, multiplied by the different standard deviation elements, multiplied by 0. So again, then this all cancels out, and you ultimately have this square root of the 0.5 times 0.25 squared, which is right here, right? We do the math here, and you ultimately get a standard deviation of 14.58%. We can see that's beneficial. We'll do also the math for if you take just the average without. If you had a perfectly correlated stock, here is an example. If you just did the weighted average, you would have had an 18% standard deviation, right? And so you're getting almost 4% standard deviation mitigation or risk mitigation or volatility mitigation by diversifying with unrelated stocks. If we did negative correlated stocks, we get down to 3% or virtually nothing. We're going down to essentially our risk-free rate, right? So that's the real benefit here, that from diversification, you just plug in your math into these formulas. And so make sure you know how to do those formulas on your exam.
Standard deviation measures total risk, systematic plus unsystematic, for a single asset or a portfolio. Beta measures systematic risk only, market risk. Beta is the measure of the assets or portfolio's non-diversifiable risk. It does not assume full diversification. It only measures the risk that remains after full diversification.
So a portfolio consists of a 60% invested in stock with a beta of 1.3 and 40% in a stock with a beta of 0.8. What is the beta of the portfolio? We just take the weighted average. You don't have to do anything fancy here. So 1.3 times 60% equals 0.78. 0.8 times 40% equals 0.32, which gives you 1.1. So nothing fancy there, and that's essentially telling us compared to the market, we are slightly more volatile than the market. So we're going to move. A company's capital structure consists of 60% equity and 40% debt. What is its weighted average cost of capital? Again, this is just weighting, right? And the whole reason we're bringing this in together is because when we're looking at beta and we're looking at weighted average cost of capital, we're going to need this to figure out companies' hurdle rates in order to make financial decisions and capital budgeting when they want to expand or if you want to invest in a company, and what the appropriate discount rate is for time value of money. In order for us to do that correctly, you actually have to understand what the cost of equity is and the cost of debt is, so you can figure out your free cash flows to the firm and free cash flows to equity investors. All right. And so we'll go into how to figure that out using the CAPM model in a little bit. But a company's capital structure here, WACC, very simplified. If you have your tax cost of debt, you're able to just multiply that out without figuring out your debt. If we don't do after-tax cost of debt, you have to figure out what that is if you have a tax rate. Now let's talk about CAPM. What's the formula? The formula is the return or the expected cost of equity overall is equal to your risk-free rate, which we determine by the 10-year yield traditionally, but there's better ways to determine it because that's also includes coupon bonds. So you could look at a 0 coupon bond for a 10-year treasury. There's other ways to do it, but you could use the 10-year treasury as a basis for this class. So risk-free rate plus beta, which would we determine based on your industry, either back testing the specific stock and seeing its volatility compared to the overall market, or you can figure it out if it's a private company based on industry benchmarks by taking a sampling of comparable companies times your market rate, which again, we could take as the average S&P 500 rate, back tested over 10 or 20 or 30 years, depending on your time frame of your investment, minus your risk-free rate. In other words, you're adjusting your market risk premium for the volatility or your risk associated with it, plus your risk-free rate is going to equal your cost of equity. And then your cost of debt is just going to come from your average debt costs, your average loan agreements. So that's 10.2%, right? So we are able to take 3% plus 1.2 multiplied by 9 minus 3%, which would equal our 10.2% total. You can see the math here. Okay, so how does CAPM fit into cost and weighted average cost of capital. So if I was to give you a question like the capital structure is 70% equity, 30% debt, and your beta is 1.1, and your risk-free rate is 4%, and your expected market return is 10%, and the after-tax cost of debt is 5%, using the CAPM to estimate the cost of equity, what's the company's WACC? First, you just figure out the cost of equity. Again, you take your risk-free rate, your market rate, 1.1 multiplied by the 6%, and then adding in the 4%, you get 10.6%. And so 1.1 multiplied by the 6% equals 6.6% plus your market free rate, which is 10.6%. Then we're going to plug that into our cost of equity multiplied by the weight to get 7.42%, 70% times 10.6, and then 30% times 5% for our after-tax cost of debt to get 1.5%. You combine those two to get 8.92%. So that's our weighted average cost of capital. That's our hurdle rate for a business if you're looking at debt and equity stakeholders. Then we can take that hurdle rate and build it into our weighted average cost of capital. Let's say that's 9%, and then use that in time value of money to make capital budgeting decisions. So here we use this example of discount rates 9%. We have cash flows of 150, 180, 200, 220, 250, and then we can figure out exactly what those cash flows look like. So on our financial calculator, we do 0 for cash flow 1, 150 for cash flow 2, or that's cash flow 1, right? The first one's actually cash flow 0, 180 for cash flow 2, 200 for cash flow 3, 220 for cash flow 4, 250 for cash flow 5. And then we're going to put that 9 as our IY. We're going to NPV it. That's 761, 890, and 17 cents. Subtract 500,000 out of it. The initial investment, you'll get your $261,890.17. That's a positive net present value, so you decide to make the decision and move forward with the project. Woohoo, we made it. That have to have an unique beta. And so example, if you have a traditional company, let's say it has a beta of 1, so it matches the S&P 500 perfectly, or has no incremental risks related to the market that you're assessing. And now you want to enter in and buy an AI market and it has a beta of 1.5, an AI, a specific project, or a project in a different industry with a different risk profile. Recalculate your weighted average cost of capital for making that, or your hurdle rate for making that decision with that incremental risk associated with it. We should look at the project-specific beta, especially with acquisitions in new industries or projects in new industries, to match that risk in order to figure out the company beta for that specific project. And then we'd have to refigure out our weighted average cost of capital to align with that new beta. And so here we go. 1% weighted average cost of capital is 8%, risk-free rate's 4%, expected market return is 10%. So what did we determine? Using CAPM, what's the required return or cost of equity, and how much does it compare to the company's current WACC? So first we figure out it's 13%. The answer is C, 13% here, and it's higher than the company's WACC because of the higher risk. And then we'd actually have to build it into the company's WACC if we were to make a decision to include it. I also want to just talk about biases for a quick second. I think it's really important when we're making financial decisions. Overconfidence is one bias. So if you are making a decision and you're a CFO and you really like your forecast historically, and you notice your NPV is high because of aggressive assumptions, and in this situation, they've added double revenues in 3 years despite limited data, the CFO notes that the NPV is high because of aggressive assumptions. It's likely overconfidence in the forecast accuracy, and we should challenge that forecast, right? And so that's a natural bias to rely on forecasts, and we should always challenge our underlying assumptions. The board is hesitant to approve a project that could lower EPS, even though there's long-term value creation. What bias is there? That could be loss aversion, right? A lot of companies, especially as they get larger, are afraid to make loss-leading decisions because they don't want it to negatively impact their earnings or EPS. But that's a very human loss, where humans tend to fear losses more than we value equivalent gains, right? And so want to make sure that when you're making a decision, you're not triggering the loss aversion bias. Okay, now imagine you have two versions of a project, and you frame one as it will generate $12.5 million in annual cash flows, and the other that it has a 9% expected return, barely above our WACC. This is called a framing bias. You're framing the positive aspects of a decision when you're selling it, and a good decision maker will try to compare it to other views. And so that should be your goal going into this when you're making decisions, is you should always be challenging yourself to play devil's advocate and ask what could make this look negative or what could make this a bad decision, so you're not unfairly being biased towards the positive framing. Now we'll talk about anchoring bias. This happens to everybody. It's great for negotiations, right? If you want to buy something, start very low so you can work your way up. If you want to get a salary, start very high so you can work your way down. But it becomes a problem in capital management decision making where you're used to, let's say, a historical 8% WACC. You have a new project that has a higher risk. Your companies might struggle taking a higher WACC premium because of the higher beta or risk. That's known as anchoring bias, and you want to make sure that you don't just make decisions because you've made them the same way historically. And then the last major bias I want to cover is confirmation bias. Let's say a CFO raises concern about market saturation, but a project sponsor highlights that the data that supports the AI products growth story and ignores studies that kind of invalidate the position. And so your job, if someone is always looking for the arguments that support their position, is to look for contrary arguments, to be a devil's advocate, and essentially make sure that you are looking at all sides. And a lot of us want to support the decision that confirms that we're right, but it's always beneficial to do a steelman argument and essentially look at what could make your argument wrong and then try to refute those positions in order to make sure that you avoid this confirmation bias. I hope you enjoyed it and have a great day. Enjoy your weekend. Bye-bye.